Ascot Resources appears to be facing some struggles. The company this week was forced to delay the restart of their premier gold operation in British Columbia, after the company was hit with further development delays at two of their mines in the region. What's more, Ascot has said they need further funding to shore up working capital, despite raising money back in November. It's not looking good here, folks. Let's dive in. Trouble for Ascot came to a head in early September, when the company announced that they would be putting their Premier mill into care and maintenance. Operations at Premier had been short-lived, with the mill processing its first ore in April of 2024 and making the first gold pour weeks later. The mill, intended to process ore from both the Big Missouri and Premier Northern Lights mines, faced challenges in terms of commissioning. And not just in a single area. Issues arose in the elution circuit boiler, carbon management, thickener flocculation, and even metallurgical sampling and estimation. Troubles with commissioning led to the company raising $34 million in July via a bought deal in an effort to plug capital requirement holes. Despite the funds raised, weeks later, Ascot revealed that while the mill had demonstrated an ability to operate at its 2,500 ton per day nameplate capacity, there were challenges to pour more gold, including an inability to continuously run the gravity circuit. Yet, in that same news release, Ascot stated that commercial production was anticipated in the second half of 2024. And then in the early weeks of September, as we've said, trouble came to a head when the mill was placed into care and maintenance, despite the claim weeks earlier that commercial production was weeks away. As it turns out, commissioning at the mill wasn't the only issue plaguing the Premier Gold asset. Development was behind at both Big Missouri and Premier Northern Lights mines, which led to a lack of sufficient feedstock to make the mill worth running. Ascot at the time said they needed 3 to 6 months' time to continue to develop the mines before they could restart the mill. At Big Missouri, development was behind by 1 to 2 months, with Ascot having no excuse for it. At P&L, there was a delay in the start of ramp development in 2023, which was supposed to begin in July but didn't actually start until December. On top of that, they seem to have got the geological model wrong, where the first development ore was supposedly on track to be reached in late September, but further development was required to access deeper ore than was initially planned. And yet, much of the 3 to 6 month delay was blamed on P&L. So things didn't really jive in terms of what the company was saying. Oh, and they needed more money. Let's take a step back here and get a sense of what Premier Gold is. Found in the southern portion of British Columbia's Golden Triangle, 25 kilometers from Stewart, the Premier Gold Project can be viewed as a conglomerate of mining deposits centered around the Premier Mill. The project has been attempting to get off the ground since late 2020, when Ascot first placed the order for SAG and ball mills in advance of securing an initial $105 million construction finance package for the project. A feasibility study released in April of 2020 outlined the project of having a net present value of $341 million and an IRR of 51% on an after-tax basis using a discount rate of 5% and a gold price of just $1,400. Yeah, the base case was literally at half of today's current spot price for gold. Those numbers jumped to an NPV of $602 million and an IRR of 78% at $1,710 gold. So in today's environment, it should in theory be a money printer. The feasibility study envisioned an 8-year mine life, with life of mine gold production of 1.1 million ounces and life of mine silver production of 3 million ounces. While an average annual production figure wasn't provided, simple averages suggest about 137,000 ounces of annual average gold production, with Ascot at the time stating that peak production would hit 180,000 gold equivalent ounces. And from a costing perspective, C1 cash costs were estimated at just $642 per ounce, while all-in sustaining costs were pegged at $769 an ounce. The study was based on the proven and probable reserves of 1.2 million gold ounces, which were contained within the Premier Gold and nearby Red Mountain projects, while 3.1 million ounces in the resource categories were largely not factored in. The mining plan basically called for the Silver Coin and Big Missouri deposits of the Premier Gold Project to be mined, followed by the Red Mountain deposit of the Red Mountain Project, with the mine plan then calling for the operation to end with the mining of the Premier deposit. All of this was to be achieved via an initial $147 million in capital costs and a further $178 million in sustaining costs for a total life of mine costs of $324 million Canadian. Considering Ascot has raised over $495 million to date for the project, those numbers haven't exactly panned out as being remotely accurate, especially now that even more funding is needed. Okay, so back to the storyline. As a result of the operation going to care and maintenance, Ascot had to first secure waivers from its current creditors to avoid going into default and losing the entire operation. Once that was obtained, they were forced to return to the market in November, raising $7.5 million in further debt via Sprott in exchange for expanded gold and silver royalties, while also raising $42 million by further diluting shareholders. As part of the financing package, Ascot was also able to secure waivers on defaults from its lenders until May 31st, 2025. But the key here was that Ascot was now well funded to perform the necessary development work to get the mine back on track. And as far as the market could tell, things were getting back on track. Development work resumed in December at Premier Northern Lights, with ventilation and initial rehabilitation of the ramp quickly achieved in a couple weeks' time. There was 115 meters to go to achieve initial contact with the ore zone, but crews were advancing development ahead of schedule and long-hole stopes were marked to be prepped for mining by the end of April. But then 2025 hit, and CEO Derek White was canned by the board of directors for the shit show that was 2024. COO John Kiernan and VP and GM Brian Schwengler were also told to make their exits. Jim Curry, former COO of Equinox Gold, Pretium Resources, and New Gold, was taking over and wanted a clean slate. His first order of business was to go to site to see for himself just what was going on. And well, he clearly didn't like what he saw. Instead of attending a scheduled conference call for investors, he canceled the call outright the day before it was scheduled, saying he needed more time to review the details. In other words, there were problems. And that brings us to this week, where Ascot has presented a less than rosy picture. Despite the company in December saying things were advancing ahead of schedule, Curry's team indicated that development is again behind schedule, which is being blamed on the limited availability of trained labor. To add to it, the company outright stated that the previously outlined timeline for the restart of mill operations is no longer achievable. The restart is now expected to not occur until July, nearly a year after the operation was placed into care and maintenance. And there's yet another funding gap, aka they need even more funds to get things to production. Discussions are said to be ongoing with shareholders, debt providers, and bankers, but it's unclear what stages those discussions are at. The bright side, if there is one, is that Curry stated that the mill and deposit are both expected to perform in line with prior guidance. That is, of course, if the company is able to resolve yet another funding gap. Okay, so let's wrap it up. Will Ascot ever get Premier back into production? Plainly, my assumption is yes, but whether there will be any meat on the bone left for early investors in the company is an entirely different question. The first 9 months of 2024 saw Ascot issue 153 million shares, diluting shareholders by 27%. And that was before a further 272 million shares were issued in November. By our estimates, shareholders in 2024 were diluted by about 76%. In the last 2 years, the share count has more than doubled. And that doesn't even factor in the reduced economics as a result of increases in royalties. So while Ascot might get its asset into production, a better question at this point for long-term shareholders might just be, what does it matter? All right, everybody, thanks for watching. If you have any thoughts on this story, please let us know in the comment section. If you have other stories you want us to cover, let us know in the comment section. Also, guys, we appreciate all the engagement we're getting. It makes us want to keep going and keep making this content for you. So we appreciate every share we get, every comment we get, every like we get, every subscription we get. Thanks for watching, everybody.